In a major move, Thai SEC bans the use of customers' quote-unquote crypto assets for lending and investment. In brackets, we'll call it yield because that's what it is. Anyways, let's dive into this story. That's right. For the Independence Day holiday, we are still dropping clips for you guys. News is a little bit light, but still some interesting stuff. And you know what? I felt that this was a good time that we go back and revisit some shitcoiner bullshit. Let's take a look at this article. Thai SEC bans the use of customer crypto assets for lending and investment. Good job. From the Thai SEC. The new guidelines require digital asset service providers to offer adequate warnings, highlighting risks associated with cryptocurrency trading. All platforms must display a message that reads, "Cryptocurrencies are high risk. Please study and understand the risks of cryptocurrencies thoroughly because you may lose the entire investment amount." They should stop calling it an investment. That's the first thing, right? Like the generally accepted wording is that we should stop using the term investment because it's not an investment. And I'm going to explain why. The new guidelines also prohibit service providers from using customers' funds for lending or investment. I just got to add that I do think it's comical that we actually have to tell people not to steal your money and reuse it for shit that you didn't approve. Okay? Like, you don't want them to be reusing your money without your knowledge. Okay? You don't want them to do it without your approval. So the fact that we actually have to create a law like that, this is why we don't have nice things. This is a perfect example of why, as humans, we do not have nice things because we can't self-police. We can't self-govern. The second there is an opportunity, okay, to make something out of nothing, like, I don't know, like depraved lunatics, we do it. So anyways, yeah, this is why the human factor screws up everything. Anyways, let's continue. The new regulations are set to come into effect from July 31st, 2023. Okay, so should start soon. So before we dive into the next piece of this article, because really, this all has to do with DeFi. This all has to do with yields. Okay, this all has to do with moving money around into quote unquote investments that aren't really investments at all. Okay, so let's take a look at how the traditional market determines yield. Most yield comes from dividends on stocks or fixed rates on bonds and debt instruments. Okay. So let's keep that in mind for a second. Many people in this space have never had any exposure to traditional investing, meaning that they've never actually bought a stock. Okay, and in some cases, a lot of people have never set up what is called a DRIP, which is a dividend reinvestment program, and that is where there is a company, okay, that returns a certain amount of its profits to the shareholders by way of a dividend payment. Now, this usually comes every quarter, okay? There are sometimes special situations where they create something called a special dividend, where that gets paid out outside of the normal schedule. But this clip is not about the dividends or the schedules, but the point is, okay? Now, how is this dividend created? So in a traditional equity, what happens is that the company is very profitable. Now, when a company feels that it can deploy its capital, right, meaning that if the company feels that they can take that profit and spend it wiser or in a better fashion than giving those profits back to the shareholders, okay, then they do not provide a dividend, okay? Or there are cases where they provide only a certain percentage of the profits as a dividend, and they want to keep a certain other percentage to reinvest in the business or to buy new businesses, whatever the board of directors deems as the correct course of action. But the point is this: a dividend is created. Profitability. The profitability comes from creating a product and selling that product, or creating a service and selling/providing that service. So there is an underlying thing that produces value. Okay, this is very important because you see, in DeFi and yields, you need to muddy the waters in order for you to think that this is the same thing but better. Now, keep in mind, what I just explained to you are real-world situations with real-world companies providing real-world value and then rewarding the shareholders by giving some of those profits back to the shareholders. Okay. Now, let's dive into some DeFi yield now that we have a bit of a better understanding of equities and dividends in equities. Now, one thing that we always tell you in Bitcoin, everyone is a scammer. I'm no different, right? My incentives line up with Bitcoin. So I'm not going to sit here and tell you that I'm not a scammer. We are all scammers. Every human is a scammer because none of us are better than our incentives. Anyways, here's an interesting article from 2021. Where does the yield come from anyways? There you go, Julian Co. Okay, now let's dive through this little explanation from Julian. One of the most dominant narratives in DeFi that regular people will be compelled to move their fiat into DeFi because of high yields. Empirically, this is true. Lending rates for stablecoins on Compound today are less than 10% APY, and there are multiple yield farming opportunities with anywhere from 50 to 200%. In the real world, most banks give their customers sub 1% rates per year on their money. Now, I will say this. The banks are definitely screwing the public, right? Like that, there's no question there. Banks can definitely afford to pay a higher level of interest, but why should they? Why? What are you going to do? Right? Who are you going to go see? You're going to go see the competition? Anyways, okay. They don't have to give that to you. But see, these platforms, they need to entice you to take to give you their money. They don't have a choice because what they're offering you is a complete illusion. Anyways, let's continue. When regular people hear these yield numbers for the first time, most express skepticism instead of confidence. This must be a scam. No, it is. The yields must reflect some hidden risk that us crypto degenerates are not taking into consideration. Yes, they are reflecting hidden risk that you shitcoiners are not taking into consideration. And the hidden risk is it's a Ponzi. There is no underlying financial activity. All there is new money from noobs that don't understand where the yield comes from. Now, remember, in the illusion, you need to make people think that these are legitimate financial products and that they're just misunderstood because they're new, okay? So there are 4 categories where yield comes from. Demand for borrowing, exchanging risk, service provisioning, and equity growth. That all sounds legitimate, doesn't it? It's just fucking smoke and mirrors, guys. It is just pure smoke and mirrors. There's demand for borrowing right now in the existing system. And guess what? You have to provide real world collateral today, okay? Nobody gives a shit. Nobody cares about your shitcoin. As the DeFi ecosystem matures and progresses along the S-curve, we will likely see yields collapse from the ridiculous 1,000% APYs. So they're ridiculous, but keep in mind, shitcoiners have absolutely no problem in shilling you those 1,000% APYs to get you in, right? But it's ridiculous right now. Well, which is it? I thought that there was some, possibly some risk we didn't understand, and that we were just being foolish about it, and that the ecosystem provides for this type of return, and yet somehow here in the conclusion, the 1,000% is ridiculous. Anyways. Equity incentives will unlikely diminish over time, and the assets will fall out of their hypergrowth phase. Means pump and dump. In this future, I expect to see more sophistication. Here we go. To me, this is the signal because this is where they tell you we're going to improve our grift when you realize the initial grift no longer works. Okay? I expect to see more sophistication on the risk exchange front as people engineer more complex financial products that can boost yields. Now, let's take a step back. Okay, in regulated markets, we had the credit default swaps and we had the mortgage crisis. Okay, and that all came from more sophisticated financial products that gave, quote unquote, better yields. And we all saw where that ended up. And that was in a regulated market that involved all of the approved, right? The approved lenders, the approved borrowers, and the regulators. So again, guys, this is such crap. So yeah. And of course, right at the end, here we go. Ribbon Finance is creating a protocol for the construction of these complex financial products and aims to simplify them so that they will be highly accessible to a large retail audience. Now let's go take a look at the author that wrote this, right? Because none of us are better than our incentives and everyone's a scammer. So this was written by Julian Co. And take a look. Julian Co. is building Ribbon Finance. The thing he showed right here at the bottom. Oh, look at that. And look at where he came from. Coinbase. Oh my God. Wow. An exchange that makes money off of people trading shitcoins. And not only that, but offered an educational platform to onboard noobs into how to trade these highly illiquid casino tokens. I know that DeFi seems pretty old, but what I want people to understand is these narratives are not dead. These narratives are not going away. The idea that you can make money doing absolutely nothing is always enticing. It's always enticing. Okay, so this isn't something that just goes away. Now, let's go back to this DeFi yield thing, right? So you're essentially you're taking highly illiquid tokens and you're staking them in the hopes that those highly illiquid tokens will give you more of those highly illiquid tokens. And of course, you would want the value of each individual token to go up as well. If you take a look in this space, specifically in that DeFi space, none of those businesses actually offer a financial service that provides value in the real world. They also don't produce any products in the real world that provide any value. Now, there are financial products like this in the real world. One of them is called a Ponzi scheme, okay? And that is where the illusion that value is being created because new people are being onboarded quicker in the beginning than the amount of money that is being paid out to the initial investors. But eventually, you can no longer pull in the amount of money that you need to satisfy all the people waiting on that yield. And this is where things start to get tricky, and that's when things start to crumble. So, going back to the original article, the Thai SEC finally putting in place these measures so that people who run these types of exchanges are not just going to go and take your funds and reuse them any way they feel. We all knew that this was wrong from the beginning. The people doing this with your money know that this is wrong from the beginning. Okay, so we have multiple problems. We have human beings that can't check their own greed, right? That's what we are. We're humans. So we have humans that can't check their own greed. And then on top of that, we have governments that LARP, that they're helping everybody. Don't wait for the governments and the SEC to tell you not to invest in something that is clearly a fucking scam, okay? You don't need the SEC to tell you this. Anybody who would have sat down and did the math for even 5 minutes would have figured out that it is completely impossible for these platforms to sustain themselves giving the yields that they give. These regulatory bodies, they are LARPers, okay? That's all they are, just LARPers. Do your own research. If it seems too good to be true, it most likely is. All right, guys, that wraps up today's clip. Don't forget to like and subscribe. Help us fight the evil YouTube algorithm. And I will catch you all on the next episode.